Okay, I think yeah we can start. So thank you everyone for joining. Thank you, Professor Jack, for joining us and allowing a workshop for PolyHack. So for those who don't know who Professor Jack is, to give an introduction of who he is, he's distinguished in many fields. He obtained 3 master degrees in business administration, engineering management, and electrical engineering. He's an advisor for AISES, which is a global platform for young people to explore and develop leadership potentials. And he's also a member of the FinTech Advisory Group at Securities and Futures Commission. So like he's been doing a lot of things in the fintech field, blockchain. He's also a mentor for PolyHack for students who are doing in the field of blockchain, as well as the best advice that PolyHack could have for us to organize our competition for all of you guys. So Professor Jack, feel free to take on and what you have share. You can share your knowledge. That would be greatly appreciated by us.
Okay, so give me a second. I'll get started. Okay, so first of all, I have prepared a deck that can easily go for 3 or 4 hours. The materials will compile from last year that we started the lecture with some of the undergraduate students who were supposed to do digital finance project. So some of the details in here dive into quite a bit of them. So I think what you want to get out from this presentation or discussion is really the intuition behind it. Don't be afraid if you just understand maybe 20 or 30% of it, because it's a very, very complex subject with a lot of details being hidden behind it. So, and do feel free to jump in. And I might cut down some of the materials if there are a lot of questions, because I think it's more important for you to understand some of the things that is being discussed rather than just brush through everything. So with that, let me get started. So what I'm going to cover is first Bitcoin and blockchain. I would not spend a lot of time on it, but I realized that some students actually don't understand how blockchain works. So I think it's worthwhile for me to actually give you the foundation skill to understand what it is. Then we cannot talk about DeFi without talking about Ethereum and dApps. So some basic understanding of what Ethereum and dApp is. And then for the decentralized finance, I'm going to talk about 3 different examples. One of them is what is called decentralized exchange. The other one is a lending protocol. And of course, today it's we have to talk about the Terra USD that went from 40+ billion down to 0. So I will give you a little bit intuition behind it as to what really is going on. And after that, what I would talk about is essentially what is going to be next coming up as to what are the evolution coming on. You might have heard a lot about Web3, so I would give you an idea of how I see Web3 and everything kind of fit together. So with that, let's just go for Bitcoins. As many of you probably know, it started back in 2008 when a person named himself as Satoshi Nakamoto wrote a white paper, published it, and essentially it caught in the timing where the global financial crisis was coming in, a lot of distrust with the government. So this seems to fit in very well. And within a year, this system was running and people actually start trading Bitcoins. So before we dive down into what exactly is a blockchain, let's just understand fundamentally how today payment flow works. Okay, so this is a very high level understanding. Sometimes when you swipe your QR code on Alipay or you tap, you don't know what is happening in the back end, but these are the steps that is actually happening in the back end. So whenever you're about to commit a purchase, so first thing is the merchants, you send a pay signal to the merchant and say, hey, I'm going to go into my shopping cart and I'm going to buy this. Okay, now that essentially automatically generate a payment request for some kind of a payment service providers. And in this case, it could be Alipay, and in some cases, it could be Visa or some other payment providers, right? And once that is done, essentially, there is a process that goes from the payment provider to check if you have the money, if you're legitimate, whether you have been blacklisted before they authorize these type of payment. And with that, if you are checked properly, then the payment information is routed to some kind of a bank or some kind of an issuing organization where they know you're supposed to have money to pay for this. And then what happened then is that the payment will be verified, and then some kind of a authorization or payment confirmation will be forwarded somehow back to the merchant. And when the merchant knows that you can pay, essentially, then you completed the purchase. Now, it's the detailed step is actually much more complicated than that, but this is a very high level view of how payment is being processed today with various type of players. Now, of course, this is very, very different than what blockchain is doing today. So here is a different transaction as to how blockchain really works. So presumably when you're about to make a payment to a merchant or you're about to pay someone, Bob, in this case, actually composed the transaction as to say, hey, I'm going to pay Alice perhaps $20. And then instead of sending it off to a payment providers or any type of gateway, what he actually does is he used his private key to sign the transaction, using digital signature to sign the transaction. And after that, it essentially broadcasted to the network. And then once it is broadcast to the network, someone called a validator, or in some of the cases you're more familiar with, called a miner, essentially pick it up and verify that indeed Bob signed this transaction using cryptography, and in this case, a digital signature verification algorithms. And we will go through some of it later on today. After that verification is done, essentially what they do is they put multiple transactions and group it together in what is called a Merkle tree. We will go through some details of it later on. And once it is grouped, then it will add that whole set of transaction onto a block that has been verified previously. When they hook it up together, they use some kind of a hash algorithm to tie it together. And after that, they essentially broadcast it to the network. So as you can see in here, the transaction does not deal with any specific payment providers or any specific banks. Essentially, the whole blockchain ensure that you indeed have the money, and you can digital sign it using your public-private key. And then when you broadcast it to the network, some parties is helping you to verify the transaction. And as a result, this transaction went through. Okay. Now, what the main differences in here and the previous payment is that the previous payment is very, very centralized. There is designated parties that will help you to execute it. But for the blockchain transaction, essentially it's decentralized. You don't even know who is there to help you to verify it. Today, it could be person A, and tomorrow it could be person B. And it depends on the transaction. These are all verified through some kind of a complex algorithm and protocol within the network. And then on the left side, where you have traditional transaction, all of the parties are regulated. Some authority will have to give them some kind of a license and allow them to play in this regime, while in the blockchain case, it's completely open to everyone. Anyone can participate, anyone can do that. Okay? And then the transaction is conducted on a private network in order to ensure the security, while in blockchain, essentially, is all open in the public. Anyone can sniff through the packet to see exactly what is going on if you understand the language that is describing the transaction. And then the transaction is verified on the left side by some kind of a supervision body. There's AML, KYC that kicks in and do all these wonderful work. And on the blockchain, essentially is verified by a trust party using what is called a consensus protocol. Okay. And some of you may have studied in computer science what exactly is a consensus protocol. And then, of course, architecture-wise, there is always the discussion that Visa can process 40,000, 400,000 payment per second, while blockchain is stuck with a small number of transactions. And there are, of course, a lot of improvements since then as to how to improve it. Now, a lot of students ask me and say, what is so specific about blockchain, specifically on all of you who is working on some enterprise blockchain solutions? And one of the reasons why I do not subscribe to a lot of enterprise blockchain solution is because fundamentally, when they deploy these type of solutions, they break the essence of how the Bitcoin blockchain was being done. So the way I look at it is there is really three key pillars. The first one is the network, the second one is the cryptography, and the third one is the software architecture. I'm going to rush through it a little bit quicker. So if you don't understand everything, at least take away with some key intuition behind it, rather than trying to understand all the details, because there is a lot of potential math in here and a lot of system architecture that goes on in here. So first thing is, it's a huge network. Instead of running 2 or 3 nodes on the enterprise blockchain, Bitcoin runs around 10,000 nodes and Ethereum runs in the order of millions of nodes. So why do you want to create these type of redundancy? Very importantly is that it makes it very difficult for people to attack. Because when it's one thing you can attack a specific node, it's another thing when you're trying to attack 10,000 nodes sitting outside in the internet. Okay. And the other thing is you actually raise the bar in terms of the cost for attack. If you really want to attack, there are techniques that you can attack the system, but it is very, very expensive for the attacker. And the third part is because of the distributed network nature, a lot of attacker will be kind of shooting at a moving target constantly, and it makes it very difficult to exploit the system that is in place. And of course, Bruce Lee's always said, be like water, so that you are kind of all over the place. And one of the phenomena that you have seen is when China banned the crypto mining, there were some impact, but it quickly moved over to other countries and the whole system continued to sustain. So these are stabilities behind some of these huge network and advantage. And the second part is on the cryptography. Now, one of the key things you should take away from here is many people misunderstand that blockchain encrypts data. Okay, the fact that blockchain use cryptography algorithm, it doesn't mean that it encrypts data. In fact, the Bitcoin, the Ethereum, none of them do any encryptions. Okay, they use cryptographic algorithms to help them to do things without running any encryption. So the first thing is hash function. For the computer science guy, you probably already know what it is. But for the business guy, what you have to get out of it is essentially a hash function is you can take any size of byte stream and then convert it to a fixed format number. And this number, most of the time, is unique. Now, it's hard to imagine that if you take a 4 GB file versus 1 byte file, you generate a fixed number that how do you compress this type of things down? The concept is not about compression. The concept is about generating some kind of an hash whereby you generate a fixed format number behind it. Okay, and the characteristics in general is that it is unique and it's very, very difficult to replicate it without knowing what is the original information. Okay, so that is really the beauty behind the hash algorithm. To give you some example, you can see that if I were to repeat the hash on a text called Bitcoin, it will always generate the same number. So the consistency part is very important, that we know that for sure it works, right? The second part is if you change a small piece of information, let's say there's a transaction that you want to pay someone $100. And if someone tamper that transaction and change it to 10,000, the hash won't work and the whole transaction will fail. And that is essentially what you want to do to ensure that no one can easily tamper with some transaction that move from one place to another place. Now, the next part that is important is about the random numbers. I will just quickly go through it, but random number is important for generating the public and private key. And what happened is that, let me just move over to the cryptography part. The random number is help you to generate some kind of a private key. Now, in the case of blockchain in Ethereum, it's a 256-bit pseudo-random number. There are some constraints as to what it is. And from that, you generate what is called a public key. The key takeaway for public-private key is private key is for yourself only. If someone knows your private key, then they can replicate everything that you're doing. Public key is something you send to everyone and let them know that this is your public key. And there is a strong relationship between the two, whereby things that is digitally signed with a private key can be verified with a public key somewhere by someone else. Now, with that, I'm not going to go into details of how digital signature works because that's something beyond what we have. And then I will kind of zoom in on what exactly is going on the software architecture. So the way Bitcoin transaction work, and so it's true for Ethereum and other blockchain, essentially what you have is you have some kind of an input, and then you paid it to some kind of an output. So for example, if you have 100 Satoshi, you can distribute this 100 Satoshi to 3 different people on the same amount. Now, one of the things that is very important is the 100 and the 20, 30, 50 should add up. If they don't add up, what it means is that if it is smaller, that means on the right side is smaller, what it means is you are going to give the access to the person, to the computer who is going to verify your transaction, and then they are assuming you're going to pay them as part of the fee. Okay, so it better match up, and if it doesn't match up, it is being treated as a fee. And on the right side, you can assemble a set of not tokens, a set of values, and then put them all in one together. So essentially, a lot of the blockchain transaction in the Bitcoin world are very simple type of transaction. And these transactions essentially are all tied together and have a relationship. So for example, if you have a 1,000 Satoshi on the left side going into the first transaction, you start distributing some of it to a different type of transaction. And then all these transactions essentially are, think of it as if they are payment from one person paying to another person. And of the one that is not being paid, they are called unspent transaction. That means that they are sitting in your wallet, you own that amount, you haven't spent it, and it belongs to you. Okay? I'm going to skip this one. And then after all these transactions are put together, as we said previously, they build what is called a block, and these blocks are tied together with a hash. Okay? And as such that the concept of blockchain comes in. Now, when you tie together all these blocks as a hash, one of the key questions a lot of people ask is, if you can do it, I can do it, someone else can do it, then how do I know which one is the correct blockchain or which one is the correct chain? Now, for the computer scientists, you might have heard of something called Byzantine general problem, whereby how do you come to a consensus when many, many players are involved in the system? And how fast can you come to the consensus? So imagine the following concept. You have a general sitting on the right side who is surrounding a city and want to launch an attack. And in the old days, there is no cell phone, no Discord, no WhatsApp, no messengers, no Facebook. How do you coordinate the attack? And if you were to kind of burn some smoke in here, everyone will know about it, including your enemies. So that's not the way you want to send the message. So as such, that message are sent kind of secretly from general to the armies surrounding the castle, and then they will essentially, a coordinated attack will have a high success rate, If it is uncoordinated, that means if some general things that they should be attacking, while some general things they think they should be retreating, the war or the battle itself may result in a catastrophe. So what you want to do is to have a consistent message that the general will send across to everyone and have some way of identifying some general may be bribed and he is not doing the right thing. So the way it works is you start broadcasting the message through some kind of a channel and networks to various parties and ask those parties to relay the message. And what if there is a general who was bribed and he starts sending a mixed message? Okay. And for example, in this case, he would send an attack and a retreat message. And this poor general sitting at the bottom and say, what should I do? I don't know. I mean, I got two different messages. And this is exactly the problem that fault tolerant computer is trying to solve. Now, the way Bitcoin or the way Ethereum solve all these problems is by the concept as whoever can build the longest chain. And you might have heard of some concept called proof of work, whereby the proof of work is there to prove that you have done something to continue building the blocks so that you cannot do front run ahead of other people, nor can you actually easily overcome building a different chain. So that's essentially the concept of proof of work. And the way it works is if there are multiple parties who is trying to have a different message, let's say in this case, there's block 2 and there is block 2 star, you have to have a mechanism to resolve for the whole army. In this case is, should I choose block 2 or should I choose block 2 star, right? And the way that the system determines that is whoever can build the longest chain. And because it takes close to 7 to 8 minutes to build one block, essentially it makes it very computing intensive to override some chain that is longer. And as such that the incentive is there that if someone has a longer chain, I would just follow that longer chain rather than wasting time on building an alternate chain associated with the system. And this is essentially how the concept of blockchain works. I'm going to skip that and move forward on something else, okay? Now, sorry about this. Something wrong with my mouse. Okay, so something you should be aware of is the concept of building these chains essentially is a race. Okay, so and we have been talking about these miners essentially racing to build the longest chain so that they will be able to earn the fee. And the reason why Bitcoin actually was so successful was because the economics was very simple. If you are hired as a CFO, all you need to do is sit there and say, how many Bitcoin am I going to receive if I invest in how many mining machines? And the more mining machine I invested in, the higher probability I would have the return. So the way it works is everyone is racing both in terms of putting in more computing power or ensuring that they upgrade on different hardware to solve a mathematical puzzles in order to complete the race. And the way blockchain works, or at least Bitcoin in this case, is it has what is called a difficulties. It wants to enforce that a block is 10 minutes. If everyone is doing faster than 10 minutes, what it will do is it will increase the difficulty so that it will make it longer next time when you're trying to solve this wonderful puzzles. So as such that this is going on and on and on, that when you increase the computation power, the difficulty increase, and then you have to put in more computing power, and the difficulties become higher and higher and higher. And this essentially is a race of why sometimes you, when you listen to other people, they will talk about the fact that Bitcoin is consuming so much power that is equivalent to a country. In fact, last time when I did the calculation, it consumed, in terms of the power that it consumed, is equivalent to some of the, I think the 11th country in the whole wide world, okay, of 200 plus countries. That's how much electricity Bitcoin is consuming. All right. So let's just wrap up the concept of Bitcoin without getting into too much. Essentially, Bitcoin, a lot of people ask and say, what is Bitcoin? When I pay $30,000 to buy one Bitcoin, what exactly is it? Okay, so Bitcoin essentially is nothing but a transaction record sitting in the database. So all it reflects is if you own one Bitcoin, there is a little transaction record in one of the transactions saying that you own one Bitcoin. That's it, right? It's not something physical. It's not something you can grab hold of. It's not something that sits in your wallet. Essentially, it's something that sits on the blockchain, okay? So when you're buying a Bitcoin, all you're doing is you're transferring that electronic record to point to you and say you owned it. And when you sell it, essentially you are delegating it and get this ownership of this transaction, all these value to someone else. So think of it as if in the database, it simply said, now you no longer own it. And of course, there is a whole set of algorithms and protocol that kind of backs behind it as to how it works. Now, I'm rushing a little bit on the Bitcoin part because I think some of, maybe a few of you already are familiar with it, but not everyone is in the same frequency. That's why I kind of rush through it quickly to give you some just basic understanding of what really is going on. Now, after Bitcoin has been around for a long time, back in 2013 or 2014, there is this guy called Vitalik that comes in and say, hey, Bitcoin doesn't run any program. What if the blockchain can run programs? So as such that Vitalik actually come up with the concept and say, let's try to build a blockchain that can run programs. And the concept of running program essentially translates to something called smart contract. A lot of you have heard of this. And the simplest way to think about Ethereum is it is a blockchain-based architecture that can run programs, right? Now, the funny story about what Vitalik was doing is when he come up with this idea, he said, well, I want to do this, but he has no money. So he doesn't know how to raise money to put it together. So in the process, what he did was he essentially launched a fundraising campaign by writing a white paper and distribute it to the public and ask people to pay him in order to implement this, okay? It turns out that with his white paper, he raised 18.5 million US dollar. And then a lot of people, of course, look at it and say, oh, you can write a paper and raise close to 20 million. Why don't I write a paper and then start raising money? So back in the 2016, 2017, 8, and 19, there was this huge chase of people writing white papers and raising millions, and in some cases, billions of dollars. So what you're seeing at the peak in here is what is called the ICO, initial coin offering days, where everyone is writing a piece of paper and trying to raise money. The largest amount that was raised is 4.2 billion by writing a paper. And those guys actually were residing in Hong Kong, okay? Since then, they have built nothing, and then investor has been suing them like there is no tomorrow, and it's still going on, right? Okay, now in terms of these type of dApps, it comes in different categories. Some people say, okay, I'm going to do gambling. Some people are saying, I'm going to do game. Some people say, I'm going to do finance. But by far, all these things that stack together, the one that generate the most interest, and on the right side is the monthly active user, is people who write things related to finance, okay? And these finance apps or the apps essentially evolved to become today's decentralized finance. So decentralized finance is essentially a D-app that focuses on finance transaction. Okay, there is nothing more or less to it. That's all it is. So it's nothing but a set of smart contracts that run things that is related to finance. So of course, Investopedia has a very gross definition of what DeFi is. I don't like what they have defined, so I go ahead and define my own, right? So the way I would define DeFi is, the first thing is, it is permissionless. That means it's an open system. That means anyone can participate. That means that there's very difficult to censor. The second part is it's fully automated. That means that you're building some program that just runs. You don't need some human in between to facilitate the transaction, and then it just run it all the way from the beginning to the end. The third part that is important is that it run on a blockchain, a distributed ledger that has the robustness and the resilience of something like Ethereum or Bitcoin blockchain. And the fourth element that is important is it's nothing but a program. In fact, in some cases, it's a set of programs, right? And the last element that is important is all these transactions are pre-programmed in such a way that you know for sure what is going to happen. So let's take an example. Today, when you try to buy a stock, you set the stock price, you have no certainty of whether this will be executed or not. If you set a stock price at market buy, you have no certainty as to what exactly is the price you're going to purchase the stock at. In the case of DeFi, there is 100% certainty. When you execute, you know exactly what you want. If the transaction is successful, you know exactly what you're getting back in return. And this is one of the very beautiful things that a lot of people like, is because now when they are facing a market, there is absolute certainty and they can fully automate this without going through any intermediaries. So that's why DeFi was such a powerful concept that a lot of people want to take advantage of. Now, of course, you might heard of the concept of total value lock. And essentially, it's a concept whereby some of the DeFi protocol are capable of locking up some of the digital asset in order to perform some kind of a financial services. And by far, at the peak time, there was close to 188 billions. I look at it this morning, right now has been down to around 135 billion of asset lock in various type of blockchain. Okay, so conceptually, how does DeFi work? Yes, it's a program, but you have to design the economics behind the program, the incentive behind the program. Without those economic and incentive, the DeFi protocol would not work. No one would come on and subscribe to it because the economics has to work in order for people to be able to use and consume it. So think about it in terms of what is the business model for DeFi. So to start with, some protocol developers is going to write a set of programs, and then with some kind of an understanding of how this specific product or protocol is being used, okay? And oftentimes in DeFi, there is one party on the left side, what is called digital asset providers. Now, in some of the contexts, you will hear it, they are called liquidity providers. So what they are really doing is they have some digital asset that they want to hold on to, and they don't know what to do with it if it is just holding on to it. So what if the value proposition is that you can contribute this asset to a pool whereby you can get some income from it? So the concept is essentially very similar to you are holding on a whole bunch of cash. The cash is worth nothing. And in the case of Ray Dalio, he will tell you cash is trash. So he wants you to actually invest it and gain some return from it. So this is exactly the motivation on the left side, where the provider were trying to contribute the asset in exchange for some kind of a return. Now, I want to highlight it in here is we did some research on this, and the preliminary finding is that most of the digital asset providers do not make money. Okay, so despite of what is being claimed, we didn't see or observe evidence that there is sufficient money to be made. And oftentimes, when they deposit the digital token into the system, they got what is called a redemption token. So instead of keeping track of the bank account for everyone, they just give you another digital token and say, with that, you can come and claim the asset. So the redemption token kind of similar to a concept where they will print you some money or print you a check, and this check can be traded in public. And when you present this check back to the protocol, you can withdraw the digital asset that you have. And if you decide to trade these checks to someone else, that someone else will be able to take that and go to the protocol and say, I will demand my digital asset back. Okay, so it's kind of a very transportable type of mechanism where a lot of people can take advantage of moving these type of asset around. And on the right-hand side, there is kind of like a consumer. And what these people want to do is they want to borrow the asset. They, for example, they want to go and say, hey, I need some USDC, which is a stable coin. Can I borrow it from the pool, whereby I'm willing to pay interest on how long and how much I borrow? Okay, so almost all DeFi has this dual concept of liquidity provider and some kind of a trader's buyer or seller on the right-hand side. Now, on top of that, as I said, the tokenomics or the economics of the protocol is very important. And oftentimes, a lot of these protocol providers will say, hey, I will give you reward if you use my service. Okay, it's kind of like I am paying you to use my service in here. Now, these reward tokens oftentimes are tradable in public, and there is some kind of value associated with it. Now, of course, we will, just like Bitcoin and Ethereum and any other coins, none of these tokens are backed by anything. So essentially, some tokens get into a loop where they are infinitely printing a lot of these tokens. And if you print too much of them, it eventually will become worthless. Now, the other part that is very important essentially is the wallet that is kind of like the key into the DeFi system. The wallet helps you to manage the public-private keys, and with the public-private keys, it helps you to engage with the DeFi protocol. So this is by far a very structural explanation of what is going on DeFi, and you can take this model, essentially look at almost every single DeFi protocol, and would be able to map these in there, okay? So some of them will have both the liquidity provider and the trader and buyer and seller. Some of them may have one side stronger than the other side, and then essentially it almost surrounds with the arrows that I have in here, okay? Now, just now what I have shown you is one set of DeFi protocol. If you look at the surface, and by far one of the things that a lot of people were confused about is they felt that they are just using one DeFi protocol at a time. And actually, this is not the way it works in real life. In real life, these protocols are used in conjunctions. That means that you have to look at the usage of these DeFi protocol in a more holistic way. Okay, you can't just look at one thing and one thing only. You have to look at the entire process, what is going on. Now, on the right side, what I have shown you is a real transaction where the traders make off $188,000 in less than 15 seconds. Okay, and it's actually being executed using a robot, a bot, okay, in what is called a private transaction. So what happened is, if I were to walk you through the details, what this trader did is he took 2.8 million USDC, which is a stable coin. We will talk about what is a stable coin later on. But think of it as if this is the US dollar, 2.8 million US dollar that lives in the DeFi environment. He took that and then he go and exchange. He go to an exchanger, which we'll talk about what is a decentralized exchange. He go to a digital exchange to swap in the USDC with a different type of token called USDT. Okay, as you can see, the value is not exactly the same, even though they are stable coin pegged to $1 because there is differences in the exchange rate. And then once he took this amount, what he is going to do is he is going to go to an A protocol, which is essentially a lending protocol, and liquidate some asset. Okay, we will not discuss how liquidation works in this specific talk, but essentially it's a liquidation process. So the trader discovered that there is a liquidation. He figured out that there is money to be made. So he does not have USDT. So what he did is he put up with the USDC and then get out with the USDT and then essentially go and help AVE to liquidate these assets. And the asset that they are liquidating is by paying back the loan that someone borrowed from AVE, and as a result, withdraw the collateral from the lending protocol. And in this case, the collateral it was withdrawing was wrapped BTC. So it's Bitcoin. And then instead of taking these Bitcoin and do something with it, what he immediately do was to use another exchanger to exchange the Bitcoin back to USDC. And in this transaction, as you can see, within 15 seconds, he has been able to make a profit by contributing 2.8 million, execute the trade, and then make off with 3.0 million. Okay, so this is how a DeFi transaction essentially works. Okay, and interestingly enough, this is not even traded by a human being. This is traded by a robot. Okay, so the trick is, how do you discover these type of transactions? And frankly speaking, the transaction fee was not even that high. It's around $800 US, okay, to get a gain of 188,000. And if you're familiar with some of the DeFi protocol, you don't even have to put up with 2.8 million. You can borrow that using a flash loan, okay? And then you can clear this entire transaction with a profit very quickly. So, so what is the key differences between traditional finance and what is going on DeFi, right? So first of all, the not so beautiful thing about traditional finance is everything is regulated. In DeFi, you can do anything you want, okay? Almost anything you want. And then in the traditional finance, you use money to buy, say, for example, stock. You use money to buy bonds. Whether it's actual paper money or electronic from your bank, they are all money. In the case of DeFi, all the transaction is done using digital asset, okay? And the execution usually, no matter how fast or how quickly, how transparent it is, usually any type of financial transaction today will have to go through a set of intermediaries, while DeFi just use a smart contract and bang, finish executing. The clearing settlements has to be done and managed somehow with traditional finance. And in the case of DeFi, it's all done through blockchain automatically without any human interference. Now, of course, the auditabilities, DeFi will claim that everything is transparent. And for the traditional finance, everything is probably available by, at the request from the regulators, right? And then on the DeFi side, there's a lot of over collateralization that goes on. And then KYC, AML, if you have heard about these terms, essentially trying to see whether you're doing any money laundering or whether you're aware of who your customer are. Those things are not usually being done over in DeFi. okay? And of course, on the left side, in the traditional mechanism, what the government is trying to do all the time is hopefully prevent you from getting into a scam or some kind of a problem and trying to protect the interests of consumer, while on the right side, everything is done at your risk, okay? There is no mechanism, no government coming in to help you to protect your asset. In fact, a lot of people of the asset that was stolen, essentially is all gone. So that's kind of like a 10,000 feet view of what is going on DeFi. Let's try to home in on what are the specific, okay? Now, there are many people who would classify different type of DeFi. And this is one of the classification of how people bucket them. The first one that I will probably spend time talking about is decentralized exchange. And the next one I will talk about is stablecoin. And the third one is the lending platform. I will not spend a lot of time on asset management, insurance, and derivatives, mostly because the number of assets or the value associated locked within those assets are not that big, okay? Majority of the activities are actually happening on these three key areas, all right? And then with that, let's just look at what type of transaction or value are you seeing within the DeFi, right? So DeFi generate in estimations ranging from 100 plus to 500 million revenue per month, okay? And it depends on the protocol that you are looking at. And by far, majority of the revenue come from decentralized exchange. And that is one of the area a lot of people, a lot of regulators are getting very concerned with as to what type of activity is going on. For your information, Uniswap has been, I wouldn't say investigate, has been cooperating with SEC for at least 6 months in helping SEC to understand exactly what is going on, okay? So Uniswap is by far one of the more complicated thing that is going on within the DeFi world. And how does decentralized exchange work? So let me just kind of give you a brief of how it works. Let me just go directly in there. Okay. So a decentralized exchange essentially, if you look at this diagram, have on the left side what is called liquidity providers. They provide the digital asset to the liquidity pool, whereby on the right side, the trader can take advantage of. We'll talk about what the trader is going to do. Now, when they provide the liquidity, one of the interesting features is that you don't provide, say, for example, Ethereum. You have to provide liquidity in pairs of equal value, okay? So let's say you provide liquidity with 1 Ethereum, and the pool actually absorbs both Ethereum and USDC. Let's say Ethereum price is now $2,000. So you have to essentially contribute 1 Ethereum in conjunction with 2,000 USDC at the same time to the pool. And that essentially is what a liquidity provider will do. Once you provided that liquidity, the trader on the right side can choose to trade in Ethereum in exchange for USDC, or the other way around is to trade in USDC in exchange for Ethereum. And later on, I'm going to go through some example as to how it works. And that probably will be one of the most complicated part of this specific lecture. But I will try to walk through it. And if you can follow, it will be great, because then you understand how a lot of these trade works. So that mechanism essentially lock in with a concept of what is called a constant product formula. Now, the constant product formula is essentially trying to enforce that just now when I said that the quantity A times quantity B is almost always a constant, okay? So in the example I just gave, if I contribute 2000 USDC with 1 Ethereum, then 2000 times 1 is always a constant across the entire curve, okay? The other thing that we discussed was equal portfolio. That means that when you contribute one asset, the quantity times the price has to be of equal value with respect to the price and quantity of the other asset. And that's how you contribute the asset in pair. So when I try to swap in some quantity of delta A in exchange of delta B, what you're doing is essentially you move the quantity, you lower the quantity of the system, and then you increase the quantity of token B. So sorry about that. In this case, what you're doing is you actually are swapping in token B and swapping out token A. Okay, so that's why at the end of this transaction, the number of token A decrease and the number of token B increase, all along this constant product curve. Okay, so let's kind of take an example of how the math works. And this is by far, if you understand this, then you can start actually implement some trading strategy within the DeFi protocol, specifically on Uniswaps. And by the way, these type of things happen very often every day. So let's kind of walk through this slowly as to how it works. Let's imagine you have a decentralized exchange liquidity pool of 100,000 Ethereum, which is complemented together with 200 million USDC. Now, the exchange price in the market is 2,000. So what you would identify is that 2,000 times 100,000 Ethereum is equal to 200 million. And at the same time, USDC, the exchange rate is $1, which multiplied by the 200 million, you get equal value in the pool. So these two actually points to the equal value within the pool. And now the decentralized exchange is in equilibrium. And the way you compute K essentially is taking 100,000 multiplied by 200 million. Okay, so now the whole liquidity pool is in equilibrium. Now, so how does the trade work? So imagine the following. You have this decentralized exchange, and suddenly somewhere else in the market, someone traded Ethereum at a higher price. Let's be a little bit dramatic and say the Ethereum price now, for some reason, in the market, in the open market, move up to 2,100 US dollars. Okay? Now, clearly, there is a mismatch between the market price and what you can get from the decentralized exchange. So a trader who spotted this will be able to come in and execute a trade whereby he or she can profit. The way you profit is if the outside world is selling, it has a price of 2,100, and the inside world is 2,000. And what I would do is I will do a buy low, sell high. I would try to buy Ethereum from the decentralized exchange and sell it at the open market for 2,100 in order to make a profit. Okay? Now, the question is, how do I execute this trade? How much Ethereum should I purchase in order for the pool to go back to equilibrium, whereby I can maximize my profit? Now, when I say it goes to equilibrium, what it means is the pool has to have an exchange rate that is aligned with the market that is outside. Okay? So how do I get to this stage? That is the question you want to answer, right? And as we have discussed previously, there were some formulas that you have to go figure it out. And based on the fact that QA times QB has to be a constant, based on the fact that no matter what happened, the value of Ethereum has to be the same as the value of USDC in the pool. And if you work out the equation, essentially what you see is that you are computing that you want to swap out 2,410 Ethereum. And by that, what it means is if you swap that out, then instead of having 100,000 Ethereum, you actually now end up with only 97,590, right? And then with the constant product formulas and the fact that they have to be of equal value, then you can then compute using the constant product formula for the new quantity of B, which now is 204,939,000 USDC. Okay, and then you can compute how much you're gonna actually take swap in terms of USDC in there. Now, once you get this mathematical formula, then you know that in order for you to move the decentralized exchange back to equilibrium, these has to be the numbers. Okay, once you know these numbers, then you're gonna go and execute the trade. The way you implement this trade is the following. You will go and borrow 4.9 million USDC to buy 2,410 Ethereum from the decentralized exchange, because the decentralized exchange has a lower exchange rate at the time that you want to execute this trade. So you know for sure that you can trade with a 4.9 million to get 2,410 Ethereum. Then what you do is you immediately sold the 2,410 Ethereum in open market. Now the open market actually have a higher price, which is 2,100. So you will be able to actually receive 5 million plus instead of 4.9 million from this trade. And with that 5 million, you can simply take 4.9 of it and pay back the loan and earn an immediate profit of 121,000. So this is essentially how you execute a trade. Now, I kind of skip out some of the details in here because I never tell you how you're going to borrow 4.9 million USDC, and I never tell you how you're going to pay it back. Now, in fact, there's an instrument called flash loan. That means that you can actually borrow without any collateral. If you identify this as a trade, essentially you can borrow a flash loan from the A protocol, you execute the swap in Uniswap, and then you pay the loan back immediately to earn the profit. Okay? So this is actually an executable trade that you can do if you discover that there is a mismatch in terms of market. In fact, the way all these DeFi works is being traded very frequently because market participants can identify profit opportunity where they can make a profitable trade in order for the market to align back to equilibrium. Now, if you also work out the numbers by multiplying the value of the Ethereum and the value of the remaining USDC, you will find out that they are indeed still equal. Okay, that is essentially the characteristics of this specific decentralized exchange. All right, I will pause in here and see if there is any questions before I move forward. Any questions? Okay. I know this may be a little bit difficult for the computer science student, but when you're trying to merge finance and technology, essentially these are the type of things you are dealing with. in some of the finance students, they may have learned how to take advantage of this opportunity, but they may not know how to actually implement this on a blockchain or DeFi protocol. So this is where you actually integrate the decentralized decentralized finance in the real finance world. Now, I have another example whereby what if the DEX, what if the Ethereum actually depreciate? How do you do the trade? I'm not going to go through it here. Essentially, it's kind of like a reverse of what it is. There are a lot of details that goes on in here, but you essentially kind of understand the concept behind what is going on the decentralized exchange. In fact, this has been the rules that a lot of the decentralized exchange works in Ethereum, in any type of blockchain environments, and it has been an algorithm that was proven to be relatively robust, and you can actually generate a lot of certainty when you were to make that trade, right? So with that, let's move on to the next part of the topic, stablecoin. Okay, so stablecoin is another type of DeFi that has raised a lot of interest, and it's very, very important part of the entire ecosystem. All right, so what's going on in stablecoin? Stablecoin, as of today, there is around 155 billion worth of stablecoin that is being locked in. Okay, as opposed to before the Terra USD thing comes in, the peak was around 183, 184 billion in terms of stablecoin. Okay, and this is one of the area that a lot of people now are very concerned, including the regulator over in US, that they are coming on very hard to trying to regulate this area. In fact, yesterday I was in a meeting with some of the government officials, and then they are also moving forward in trying to regulate in this space. So why is it important to have a stable coin? So first thing and foremost importantly is traders like to have a denominations where they can think and equate all the asset in a common fashion. And stablecoin essentially is that instrument that helps them to do it. There is no volatility because the definition or the way it is designed is supposed to be stable. And oftentimes, let's say if the market is going down, you will be able to move your digital asset into stablecoin to protect the loss of your investment. And vice versa, if the market is moving up, you will be able to use stablecoin to help you to make very efficient purchases as the market is moving up, instead of waiting for your deposit to get into the broker, so that the broker will be able to release it and let you buy and sell some of the stocks, right? So this is a very efficient mechanism, and that's why it's very important. The other part that is important is truly digital. There is nothing you have to be concerned about moving money from, like in Hong Kong to United States or to Europe. It's all digital, it just moves seamlessly. And then oftentimes, stablecoin is being used because you're trying to avoid what is called a fiat conversion discount. So if you have a Bitcoin, which potentially is trading at 30,000, when you go to exchange and say, hey, can I redeem it with cash? And they might only pay you 29,000 instead of giving you the full 30,000. And similarly, if you were to purchase a $30,000 a Bitcoin at 30,000, they may ask you to pay more than 30,000 US dollar in order to purchase that same Bitcoin. And essentially, stablecoin doesn't have that. Whatever you see is whatever you get. And that's why one of the key things I mentioned early on is that DeFi has the characteristics that all the execution are very certain. Now, also, stablecoin has been malicious in many academic paper, and also understood by the government that it has been used as part of the market manipulations. And then it also has been used in part of the future contract settlements. And then in the past, it has been avoiding some of the regulator scrutiny, but it's no longer. I think right now, especially with last 2 weeks, what's happening to Terra, a lot of people are now putting a very, very strong microscope on all these stablecoin as to what exactly is going on. Okay, in general, there are 4 types of stablecoin. The first type is what is fiat backed. That means that, okay, you claim it is stable, so why is it stable? Now, the reason why it is stable is because you can take that stable coin and redeem exactly in the amount in fiat. So let's say you own 100 USDC, you will be able to go to exchange and say, hey, I want to redeem it. And the exchange will actually be able to give you $100 in exchange for the 100 USDC that you surrender to them. Okay, so it's a one-to-one fiat-backed mechanism. Now, the only issue is that how do you know that it is actually backed fully? That has been one of the biggest debatable questions. Okay, and if it is not backed fully, what if everyone is trying to redeem at the same time? So imagine if a bank, let's say a bank hold $100 million deposit from all the depositors. If one day suddenly everyone wants to withdraw the deposit, the bank will have no way of paying it back because oftentimes the bank has given out loan to other people and they don't have the cash reserve to pay back all the depositor who wants to withdraw at the same time. And this is by far one of the biggest issue with a lot of these stablecoin. And the issue that contributed to UST falling to nowhere was also because the fact that Binance decided not to redeem USDC. Essentially, it stopped the redemption. And when the redemption stopped, people lose confidence. It's kind of like you go to a bank and say, hey, I want to withdraw my deposit. And the bank comes to you and say, no, you cannot withdraw. And suddenly you go into a panic mode. You're trying to figure out how do you move your money to other places where you can withdraw. And that's exactly what happened to UST. The next type is what is called commodity backed. We're not going to spend a lot of time talking about that. And the third type essentially is crypto backed. By far, one of the one that is most prominent is the MakerDAO DAI stablecoin. And the last one is essentially something that a lot of people believe are going away very soon, is the algorithmic backed stablecoin, which USDT was one of them. Now, for the fiat back in last year, some of these companies essentially disclose what exactly is backing some of these stablecoin. So in the event that you are trying to redeem, they want to make sure that they have enough liquidity for you to cash out to redeem these stablecoin. And stablecoin is actually not as stable as you think. If you try to compute the price against this packed $1, they fluctuates over time. Okay, let's talk about the example of Terra. A lot of people are trying to understand what is going on with respect to Luna and UST, right? And essentially, Luna and UST is one of those stablecoin that is, in my opinion, poorly designed. It turns out that I was actually lecturing this last year. I forgot that I have this on my lecture notes. So it is essentially maintain the stability using some kind of a monetary concept, except that I think Do Guan didn't get it right 100%. And I heard some news or some people write up as a lot of economists essentially is telling him that it doesn't work, but he kind of go with it anyway. And the way he designed this system is that there is this thing called Luna and there is this thing called Terra. Okay, so Terra is the stable coin and Luna is the floating tokens that has some kind of a value sitting outside. So the way he prescribed it is that if UST is trading above $1, what you want to do is to print more money so that the value will be diluted as such that the price will move from above $1 down to below $1. Down to be at $1, okay? And the way the mechanism works is very interesting. And then the way it works is you can buy $1 worth of Luna, okay? Whatever Luna is being traded on. And then there is a swapper, very similar to the decentralized exchange, except it's built in to swap in based on the existing price. You can swap in that $1 worth of Luna directly with $1 UST. Now, because you are injecting this $1 UST into the market, and you can sell this $1 UST at the open market at a higher price, this selling activity essentially will help you to drive the price down back to 1 until it becomes stable. Now, the thing that fall apart in here are a couple of things. First, Luna is a floating asset. It can be of any price. The second thing is there is no guarantee when you sell it, it has to go back to 1. Okay? It's an objective function, but it's not necessarily something that the market will go into that equilibrium. Now, contrary, if it is below $1, then you kind of play the reverse game, okay? And the reverse game is if it is below $1, then what you want to do is that you buy things off from the market so that there are less UST in circulations. And as a result, the value of the UST will move back up. Now, this whole concept is flawed because the whole money sitting outside has no value in the beginning. And the fact that you're moving the demand and moving the supply, increase or decrease it, it doesn't really change anything because there's nothing to base your value on. It's just a perception or a target where everyone believes that it should be $1 because some promoter come and say it should be, okay? It's kind of like, trust me. Now, the thing that starts to fall apart is the following. So what I'm plotting in here essentially is the market cap of Luna, which is backed by nothing, and the market cap of UST. Now, because UST is supposed to pack to $1, you can think of this UST from most part of it all the way up to before May 1st, as if it is the supply of UST, okay? And what I'm plotting on the right side is this blue curve that what I call over collateralized percentage. What it means is if I have some kind of an asset sitting outside, how much of the asset are backing it in order to make it what it is. So imagine the following, right? So if I go and issue you a $100 note, and I tell you that, hey, I have $150 in the back that I will back it. So in case you come back to me with this 100, I will be for sure be able to redeem you with 100 because I have a war chest that is bigger than what I am sending outside. Okay. Another way to think about it is think about it as if it is kind of like an IOU outside and IOU sitting outside. And if I have enough cash to pay back my loan, you wouldn't be worried about it. And if my cash is visible, you know that I would be able to pay it back. As a result, you feel comfortable lending it to me. Okay. Now, this whole thing starts to fall apart starting actually around November timeframe. So this doesn't happen suddenly. This happens actually starting November timeframe. Now, if you were to plot this curve for a few other algorithmic back tokens, what you will observe is there are a couple of them which currently exhibit such a behavior. Okay, that means that those things are eventually going away. Now, if you zoom into this part of it to really understand what's going on, between November till now, UST has been issuing, meaning printing money, on an upward trend curve, while Lunar, the backing currency behind it, is not going anywhere. What you're actually seeing is a behavior where a lot of the UST getting minted, meaning money being printed, at the expense of Lunar, and someone is seemingly trying to pump up Lunar so that you can issue more UST over time. Now, before the whole thing collapsed, you actually would see that the collateralization has reached a critical point that suddenly, and when this critical point is reached, everything starts going on a downhill. So in fact, it goes so bad that Lunar, in its total market cap, is worth less than the circulations of UST. And a lot of it has to do with the fact that what I call counterparty risk, where exchange such as Binance start to refuse to redeem UST. And when they start doing that, a lot of people lose confidence. Okay? So that essentially is what happened to some of these algorithmic driven stablecoin. Any questions in here? I saw that there was a question and say, why do people want to buy Luna? One of the reasons why people want to buy it is that it's because of greed. The way it is there is this protocol called Anchorage, sitting in Korea, that if you deposit money in there, if you deposit Lunar in there, if you deposit UST in there, you would be able to earn 18% return on an annual basis. At least that's what they claim. Okay? And as such, that it was actually driving not only greedy consumer, but in some cases, some greedy hedge fund that they would buy USD and put in there and start assuming that they will get a positive return. Now, you also notice that during this period, one of the reasons why UST is going up is because as people buy UST, the supply move up. This is also the period where the US stock market is falling big time. So as such that a lot of investors thought that this potentially is a safe haven where they can park the money in a high yield instruments. And of course, they didn't study well enough that this whole thing is a vaporware. And that's why the whole thing fell apart. Okay, I hope that answered your question, Jacqueline. By the way, in US, there's this company called BlockFi. They issue similar product. Interestingly enough, SEC actually shut them down. And then in the process, they actually fined them $100 million US for doing those type of products in the market. Okay. By the way, this 18% thing has been floating around for a while. I had some of the students that are trying to analyze some of these protocols, whether they indeed can generate these type of return. Unfortunately, we don't have a lot of time to cover a lot of bases, but on some of the few that we have done some analysis on, none of them has shown evidence that they would generate any type of return, not even mention it's an 18% return. Okay. All right, let's move on. So that was for stablecoin, and I'm going to move on to talk about the lending platform. So these three are really the key foundations for a lot of DeFi activity that goes on around the world. Okay, so what exactly is lending protocol? So the concept of lending protocol, as you have seen previously from my diagram, again, on the left side, there is a concept of liquidity providers where it interacts with a set of digital asset liquidity pool where they deposit the asset in there and expect to earn a return, some kind of an interest, very similar to you put money in the bank and expect to earn some kind of an interest in return. And on the right side, there is a consumer, in this case, a trader, who wants to borrow your asset and trade with it and is willing to pay a fee. Now, this fee that they pay to the digital asset pool in returns will represent a interest earned based on the asset that the liquidity provider put into the system. So this is kind of how the ecosystem works, that someone put money in, someone borrow it, and then when they pay interest, you actually earn interest from it. Now, this operation is actually no different than what the bank is doing today. What the bank is doing today is to take in your deposit and then lend it out to some kind of a borrower. They will get interest from the borrower, and in between, they will earn some kind of an interest rate differential and pay the excess back to the depositor. Okay? So you can think of this as if it is a bank, except that the asset that is being deposited are fixed in the case that it could be Ethereum, it could be Bitcoin, it could be some kind of a stable coin. And if there are parties who is willing to borrow Ethereum, who is willing to borrow Bitcoin, who is willing to borrow some kind of a stable coin, then you earn a fee that will pay you back as a depositor. So this is how the lending protocol works. Sounds simple. If you explore this to the extreme, it is an extremely powerful concept. Okay, so this graph on the left side kind of show the type of transaction where people put money into the liquidity pool. And as you can see, on a monthly basis, these things can go as high as 30 billion. Okay, and there is equivalent of a 30 billion type of withdrawal on the other side. And in terms of the lending activities, it's in the order of probably around 5 to 15 million per month. All right. Now, the thing about this lending and borrowing is based on a very important concept of what is called an interest rate curve. Okay, so the interest rate curve essentially is fully programmed into the smart contract as to how it works. Okay, on the vertical axis essentially is what is called what exactly is the borrowing rate. That means what is the interest that will charge you if you start borrowing some kind of an asset. On the horizontal axis essentially is what is called a utilization. The utilization is defined as the total that is borrowed over whatever is in the bank. So think of it as if you are the HSBC, how much money you have lent out and how much deposit is still sitting in the bank. The ratio of those two is what the lending protocol called utilization. Now, the interesting thing about how this is designed is that it obeys demand and supply, or law of demand and supplies, almost perfectly. Okay, so this is kind of the way how it works. So try to follow this logic, right? If there is a lot of borrowing within the system, that means the numerator, okay, is going to increase. When the numerator increase, utilization increase. When utilization increase, you can see that because of the way the curve is designed, interest rate will start moving up. When the interest rate of borrowing becoming too expensive, it essentially discourages borrowing. So what you're seeing is the effect that when there are more people who borrow, eventually it will reach a state where people will not borrow or retract from the borrowing because interest rate is getting too expensive. All right. At the same time, if there is not enough borrowing, utilization will decrease, and coming with it is interest rate will also decrease. When interest is cheap, such as 2 years ago when COVID hit, everyone started borrowing and leverage up, right? So when interest rate is high, no one wants to leverage. When interest rate is low, everyone wants to borrow in order for them to leverage up the position. So this is exactly how the interest rate curve is being designed. So let's look at the other component in terms of the deposit. That's the total liquidity. If there are a lot of people putting money in the bank, what happens is the utilization will move down because liquidity becomes large, utilization will become small. And as such that when the utilization moves down, you can see that the interest rate actually decrease. When the interest rate decrease, essentially it discourages people from depositing such that the liquidity will kind of slow down. The increase of liquidity will slow down. So again, you see this effect where it self-feed each other, that if it goes too much, it will try to retract itself. And similarly, if the liquidity decrease, that means the denominator decrease, utilization will go up. When utilization goes up, interest rate goes up. When interest rate is high, a lot of people want to make deposit because they can earn from the interest rate instead of taking a risk from the market. So this is essentially almost how all the interest rate curve is designed. And this slope in here essentially follows some kind of economic principle to encourage and discourage behavior in order to keep everything at equilibrium. When I say at equilibrium, what it means is you don't want to have excessive borrowing. Now, then the question is, why is this kick in here? And it's called the jump curve, right? The reason why that there is this jump curve is to strongly encourage people to take action, because interest rate now suddenly are moving very rapidly either up or down. And essentially this 80% that is set as a threshold is a way for helping the system to maintain its stability, hopefully below the 80%. Okay, so some of my students were doing research as to say, if it indeed goes up, does it move down quickly? Okay, because you will want to see the economic behavior whereby if it is too expensive, people will retract from the system, both in terms of lowering the borrowing or increasing the deposit. All right. And as such that this kick is there to accelerate the behavior so that the pool won't overflow. Okay. And essentially that's kind of how the interest rate curve works. So far, I have been talking about all these DeFi. We discussed 3 of the key components of decentralized finance. The first one essentially is the decentralized exchange. The second one essentially has something to do with the stable coin, which is a very important currency to work within the system. And the third one essentially is the lending protocol, how you do lending and borrowing. Now, as I have shown it to you in the very beginning of the presentation, oftentimes these different DeFi protocol are not used by itself. It's being used in conjunctions in order to execute some kind of exotic trade so that trader can take profit. So what is next? What is coming on next, right? Well, what we have been observing now is that Ethereum essentially is running too slow, too expensive, and relatively incapable of handling the capacity and volume that goes up. So back in the very beginning of May, when the Bored Apes were trying to auction off some land, essentially it run Ethereum to a halt. The transaction costs shoot up like crazy. And essentially what it simply means is that Ethereum can no longer bear a lot of these activity that goes on. As many of these digital asset or DeFi, and then we will talk about NFT a little bit later on, become more pervasive and used by many people, this thing start to fall apart. So what we have been observing is that no longer do we see Ethereum as the dominating blockchains for digital asset transaction or DeFi. What we have been seeing is a lot of the activities are now moving off Ethereum in different kind of fashions. On the left side, essentially, is something called L2. A lot of people call it layer 2, and then Bitcoin also has its layer 2. In fact, in El Salvador, a lot of the Bitcoin transactions are executed at the layer 2, which is called Lightning. In Ethereum, a lot of transactions are now moving to layer 2. The other thing that is happening is that a lot of transactions are also moving off to what is called a sidechain. Now, the differences between sidechain and layer 2 in general is that sidechain usually is a fork of Ethereum with some minor modification, where layer 2 could potentially be a completely different design, okay, of how data is stored, how code is being executed, and in some cases, the code executed in layer 2 may not be even compatible with Ethereum, while in the case of a sidechain, there are some compatibilities, but what we have observed is that the address no longer match, okay? And then, of course, there is these new breeds and the old breeds by Binance that kind of run off by itself because it felt that Ethereum was too expensive in terms of its gas. So Binance actually fork off BNB chain at a much lower gas fee so that people will be more willing to transact over the Binance chain than directly over Ethereum chain. Now, there are some differences between the Binance chain and the Roni. The Roni essentially has very limited functions that is dedicated, for example, to Axie Infinity, while the Binance chain are more general that has a better compatibility with respect to Ethereum. And Solana is something that is totally different, that promise better, faster, cheaper than whatever exists, okay? Now, a lot of these connection, instead of building it as a totally different blockchain, is being tied together with what is called a bridge, a wormhole, and all these wonderful things. And if you have read enough news, my joke to my friends in the PolyHack is that if you see a bridge or wormhole that has not been hacked, it's just that there is not enough money in there. If there is enough money, it will be hacked, okay? So the security of some of these bridges, I would say, is very questionable, okay? Because to a large extent, you have to trust the counterparty as to what's going on. While if things live within the Ethereum blockchain, you don't necessarily need to deal with counterparty risk, right? And then this type of behavior has been quite observable. I should have plotted this graph all the way up to 2019. What you would see is back in 2019, it's almost 100% based on Ethereum. And as it moved closer to today, Ethereum shares of what we call the total log value has been diminishing. That means that a lot of the value are now moving off to bridges or moving away from Ethereum. So that is what is happening now, okay? The other thing that adds a variable in there, in addition to the traditional DeFi, is the story of NFT and Metaverse. Now, I didn't use Metaverse in here because I think if you ask 10 different people what is Metaverse, they will give you probably 12 different answers on what is Metaverse, while in the case of NFT, it's much clearer. Now, the thing that you might want to take advantage of, and from a regulator standpoint, you might be worried about, is that NFT is going mainstream big time. A lot of companies are really looking for using NFT to further monetize the IP that they have. Many companies are currently working on this, trying to figure out how to monetize and grow this space as quickly as possible. And there are, of course, a lot of theses as to how you do it, but let there be no doubt, this is going to mainstream and they are not waiting for the regulators. Now, the funny thing is, if I actually asked the regulator almost 1.5 years ago and say, how do you classify NFT? And at that time, no one has even heard of it. Now, if you ask people what is NFT, almost everyone knows what it is, okay? So it's becoming very, very pervasive in many different areas. Now, by the way, NFT also include some of the games. So Axie Infinity is one of the games that is being often talked about in this NFT world. Now, how I see this whole thing moving forward, essentially is a lot of people talk about Web3, and I read a lot of articles or reports about Web3. No one has been able to actually clearly articulate exactly what is Web3, and this is my spin of it, of what I think is Web3. So on the left side, what you're seeing is more an investor-centric view of all the digital asset activity that goes on. Something we have been discussing in the last 1.5 hours, okay? All the cryptocurrency trading, all the decentralized exchange, stablecoin, lending platform, all these things that goes on. Now, with whatever is going on, we know that the cryptocurrency is moving out of these platforms, and so it's fiat. On the right side, it's what I call the consumer-centric view of digital asset activities, where you have the arts, the collectible, the GameFi, the physical and digital asset tokenization, metaverse, and any type of apps that is kind of tradable. And sometimes you would classify all those as part of the NFT ecosystem. Now, the funny thing about these two is they are all commutable. They are all being traded with cryptocurrency. A lot of the NFT were bought and sold using ETH, right? So it's undeniable that they are one and all tied together, and yet people relabel them and say, hey, this is just an art. This is just a digital tokens and a digital artifacts. And yet it is tied in very tightly with the entire crypto system. Now, the way I see Web3 is essentially it's the layer that bring all these things together so that you can no longer differentiate between what is cryptocurrency, what is DeFi, and what is NFT. And most importantly, how this all tie in with today's internet, okay? Now, let there be no doubt, Samsung actually start making smart TV that allow you to do NFT marketplace, okay? Instagram will be launching NFT compatible face shot so that you can essentially upload an NFT as part of your face in Instagram instead of uploading a picture. And there is mechanism to verify that indeed you own that NFT, right? Instead of letting anyone just put things in there, okay? There are ways you can differentiate it. And what is there to prevent it from moving another step forward in terms of carrying out trade on some of these NFT within the most common used social media platform? So this is a very good example of how DeFi and NFT actually fits together. On the right side, this little pumpkin here that you see is a 24 by 24 pixel PNG file, okay? It was traded at 500 million, okay? And the way it is being done, without going through the details of how this complex transaction work, essentially is done using a concept called flash loan. So what the trader done was that it borrowed 500 million from the 8th lending pool, use that and go through a whole bunch of DeFi protocol, including Compound and DYDX, implemented a trade of a CryptoPunk, which you see on the right side, with 500 million worth of ETH, and then return the whole thing back to the original owner, and at the same time pay back the loan of 500 million US dollars. Okay, all these done in a single transaction. Now, if you start having doubt as to how these two actually work together, they are live example all over the place, as on the left side and right side, how everything is being put together. Okay. In fact, we did some analysis on some of the CryptoPunk trade. 80% of them makes money, and guess how they do it? A lot of them through these type of transactions. Okay. It's going to be, from a layman's standpoint, very difficult to differentiate whether these are real trade, wash trade. And unfortunately, the way to determine it is, at this stage, you almost have to get down to the blockchain transaction level to observe how this trade is being executed in order to determine whether it is a wash or a legitimate trade. Okay, so these things are already happening, and that's why sometimes when you see arts, apes, whatever it is that sold for millions, you would be able to actually go to the blockchain level and trace back exactly what is happening to determine what is going on. Okay, so to wrap it up and summarize it, what is the future of DeFi, right? Well, in many ways, DeFi and NFT are growing. There is another interesting news, is that it seems that the regulators are no longer trying to stop everything. They will try to regulate it, but they are in the process of trying to figure out how to let some of these innovation continue without stopping everything. Okay, but not stopping it certainly poses a lot of risks in terms of consumer as DeFi and NFT integrates, which is already happening now. So that comes to my next point, where a lot of these talk about Web3, how powerful it is, really kind of aim at unifying a lot of these ecosystems together so that it is very seamless, that you can no longer differentiate what a NFT commercial trading, a game is, versus cryptocurrency trading. Okay, so this is happening. And the other thing that that I have mentioned many times is Ethereum doesn't scale anymore. So in order for these activity to actually happen, there will be a lot of platform dispersions. Many of the blockchain will be flowing up, such as Solana. Okay, there will be a lot of bridges. There will be a lot of wormhole. There will be a lot of fork of Ethereum and trying to change it so that it become more efficient, better, faster, cheaper somewhere. So a lot of the efforts will be paid on how to ensure that the platform that a lot of these things were built on will scale over time. The other part that is getting a bit scary is when blockchain first come to market, one thing that it prides itself on is all the code are all open source. The blockchain is fully transparent to anyone who wants to examine the transaction. Now, the problem is the fact that it is open doesn't mean you know how to do it. Partially is because of the complexity. The whole thing is getting very complicated. It's not going to be easy for a layman to, in the past, go to a Bitcoin Explorer to look at, oh, a coin is transferred from person A, address A to address B. And if you were to examine similar thing on Ethereum, on DeFi, it's a much more complex transaction. Okay. And now when you can move these transactions through bridges to other blockchain, so for example, in the case of Axie Infinity, they were started in Ethereum and they move everything to Ronin network. And back in Ethereum, there's less than 750,000 address. And in the Ronin network, there's 10 million address. So one would even wonder whether this 10 million address, how it mapped back to Ethereum on the 750,000 addresses, right? So you now get into a story where it's getting much more difficult to do address tracing. It's getting much more difficult to do transaction tracing. And some of this database is huge, right? RONI network within a year has close to 300 million transactions. Blockchain, Ethereum up to today have around 1.4 to 1.5 billion. So if RONI network continue to grow the way it is, it's going to outgrow even Ethereum very quickly in terms of number of transactions, which makes it very, very difficult to capture the information and to understand what really is going on. Okay. And then the other part that is always flopping in is the social media, right? There has been a lot of discussion, and you might as well remember this acronym is do your own research. Now, unfortunately, I don't think a lot of people will be easily understand what a decentralized exchange protocol works. Okay. By the way, the decentralized exchange or Uniswap protocol was a PhD thesis from some guy in Canadian Mellon. Okay. He actually took that, implemented it, and get it to work. And since then, very few people has been able to replicate something similar that is as robust as what is being done. So it's not going to be something that is so simple that anyone will be able to jump in and appreciate the issue associated with these type of algorithms, the behavior, and the characteristics. Okay, so a lot of the industry people are advocating do your own research. Now the problem is, where do you get started? There are too many noise outside that doesn't allow you to easily differentiate what is real and what is not. Okay. In fact, the way I tell a lot of my students is that go down to the blockchain level and look at what's going on instead of listening to what other people say. Right. Security will get worse. That is by far no doubt. Codes are very poorly written. A lot of them doesn't take into consideration. In fact, this morning I read another article that Terra protocol was broken 9 months ago, that there was some exploit in there that people are aware of and no one there is there to fix it. Okay, so even though platform that has billions of dollars on top of it, it could have bugs, right? And lastly, the regulation will come in. In what form or shape does it come in? I don't know. I know that they are very behind, and I know that they will have a hard time catching up, but they will eventually catch up. SEC is still trying to look into fraud that was committed back in 2019, 2018. Now it's 2020 already, 2022 already. So the regulators are lagging behind, but they are trying to catch up with the limited resources that they have. Okay, so with that, I will close the discussion. That's all I have for today talks. And I will open it up for any questions from the audience. You can either do it through chat or unmute and ask me about anything you want.
So if anyone has a question, feel free to drop it in the chat. I can read it out for you, or you guys can even open your camera and ask any questions.
By the way, as I said, I don't expect everyone to fully comprehend what is being discussed in here. I think the important thing is for you to pick up some of the pieces and get some idea. It does take a lot of time to ramp yourself up to speed on what's going on. It's not supposed to be an easy subject, okay? Because the minute you combine technology and, for example, some of the trading strategy that I was showing you, it's not that quickly you can comprehend if you are not working on it on a day-to-day basis. Okay, so don't feel bad that you say, wow, I don't understand most of it. Okay.
So we do have one question. It's what are the implications of elastic cryptocurrency supply in reference to stablecoin? Can stablecoins being linked to elastic coins solve the problem of stablecoin collaterals?
I have to pledge ignorant in here. What do you mean by elastic coin? Do you mean those tokens such as, I don't know, Uniswap or Maker or Luna?
Yeah,
whatever?
there's a new one called Amplify.
Okay, I haven't read up to it. What is elastic coin? When I read up to it, I'll let you know. I will make a note on that. I haven't follow up on what exactly that is. Okay, good point. I'm learning something in here.
So we have another question. Is it possible for governments to create a federal reserve for crypto? Can the government implement the money creation process in DeFi? If not, isn't it a bad idea to make it a conventional currency?
Okay, so there is something called central bank digital currency that is in the process of implementing. I happen to know some insider information which I cannot disclose in here. So the one that has been disclosed is that in China is one of the first massive scale launch of CDBC, central bank digital currency. Now, of course, there is a lot of discussion that China central bank digital currency are not built on blockchain, but that's kind of irrelevant because if the central government is going to control everything, what's the point of building on blockchain anyway? So that essentially is a attempt to trying to tokenize a country reserve currency. US at this point in time doesn't feel that there is an urgency, and I think what they are doing is they are looking at China and see why they are doing that. And in Europe, there is also an evaluation of what is called digital euro. Again, the European government are not very eager to replace its existing system with the central bank digital currency. So let's look back on what is going on in China. I think one of the important motivation for China to do what they are doing is that they want to dilute the influence of Alipay and WeChat Pay by introducing a formidable party that can kind of counter with them. That's one aspect. The second aspect that there has been a lot of denial sitting outside is that if a central bank digital currency is being issued, the Hong Kong MA are actually working with Thailand government, the Chinese government, the Dubai government on implementing some kind of a digital currency transfer without using the SWIFT system that is being used in the United States. In fact, the thing that was very clear is when the US government threatened Hong Kong that they might turn off the SWIFT system, that automatically triggers the acceleration of looking into using CDBC to bypass the existing SWIFT system. Okay. Now, whether there will be any DeFi run on government-related process, all I can answer you is yes, there are people looking into that. Okay. Any other questions? By the way, in the last probably 6 months or not even 9 months, the only fintech area that people has been making investment in is blockchain related and cryptocurrency related area. I haven't been able to put together the data, but I bet you that almost all the other fintech area has went down the tube. If you look at Coinbase coming up from its peak to now, looking at Affirm, looking at Robinhood, all these things are traded at like rock bottom below the IPO price. Okay. All right, another question. Oh, okay, the process is still not mature inside the secret tech involved in the current phase. There has been a lot of work done in the central bank digital currency. I wouldn't say the process is not mature. I think it's a matter of the timing. When is the best timing to start launching such activity. There are incentives for nations to develop their own central bank currency. So think about it as the following. No matter what happened today around the world, even though there is euro and there is renminbi and there is Hong Kong dollars, there are Canadian dollars. If you also look at the situation a few years back when Italy went into trouble and it cannot save itself with devaluing its own currency and it has to rely on euro, there is definitely an incentive for any big enough nations to own its own currency if they can substantiate its value. Okay. By the way, one of the things that I foresee will happen for stablecoin is it's going to be like, if you understand how currency works around the world, stablecoin will eventually be something like that. Okay, so just very quickly, how currency work around the world is US government is printing probably, I don't know, 4 to 8 times of what they have in reserve. So last time when I look at it is US government has close to 500 billion in foreign reserves sitting in the bank, including like gold and everything else. The amount of money they are printing is the order of trillions. So one would wonder and say, how come it doesn't collapse? Similar to the story I just gave it to you with Terra, UST, and Luna. It was because people trust the US government. And if you look at the other nations like Japan, China, the foreign reserve are huge when they are issuing these renminbi. So similar thing I think will happen in stablecoin where there are some kind of a reserve structure to be formed in order to maintain its stabilities and confidence. Okay, but that is to be happen. But it almost have to resort in some kind of a scheme like that. Otherwise, no one would trust it. Any other questions?
Okay, if nobody has any questions, maybe before we go, we can take a picture with everyone. So to mark this as an event so that we can host it globally. So if everyone could take turn on their cameras just for a few seconds so that we can take a picture with Professor Jack, who has given us tremendous knowledge for you guys to build your own. Maybe you can build your own DeFi, and that would be a great project for you to show us. You can show that you excelled. So tech team.
I'll do it. I'll do it.
Okay.
Yeah. So participants, if you wanna take picture with us, you can now turn on your camera. All right. 3, 2, 1. Okay. We got the pictures.
Thank you very much.
All right, I hope this is helpful. And again, DeFi is not something that is trivial. There is definitely some time you have to invest in it in order to fully understand what's going on. Given that said, I also would say that people who actually understand this space better, the pay scale is a lot higher. I have a lot of industry contact that are looking for very good people, and they are willing to pay a lot more than just a regular graduate if you know how to program, if you know finance, and if you understand DeFi. Okay? So something you might want to think about. Okay? With that, I guess it's time for log off. All right, thanks. Bye-bye.
Thank you very much.
Okay.